Hey, what's going on, guys? Welcome to the 6th video in the Aerial FX Beginners course. In this video, we are going to be discussing candlestick patterns and formations, an introduction to technical analysis. So, candlestick patterns and formations can be very helpful in determining potential bias for the next larger move and shifts in structure and potential shifts in momentum. All right, they're not. You should not trade them solely just because it's a particular pattern or formation. You need to use them in conjunction with one another, as in conjunction with other confluences and your particular rules for your particular strategy. So you cannot just see, oh, okay, well, we have a potential candlestick formation here, which I'll get into in a minute. Oh, you can't just see that and just be like, oh, I'm going to buy it and it's just going to go long. In this case, yes, it did. All right, but there could be other factors and other things that you need to look at, and your other confluences for maybe a potential short opportunity instead of a long opportunity. There's just other things that come into the market just besides candlestick patterns and formations, but they can be very helpful in use with other confluences for your particular strategy and trade entry, and they can be very, very helpful in determining maybe potential shifts in volume, shifts in momentum for either a pullback or a potential reversal. So let's just get right into it. So the first pattern I want to go over, and actually the first candlestick formation I want to go over with you guys, is called the 3-pin pattern. The 3-pin pattern can signify some sort of pullback or reversal formation. All right, and is identified, and it's just really just what it is. 3 pins, 1 wick, 1 pin, 2 wick, 2 pin, 3 pin, or 3 wick, 3 pin, engulfing back to the upside. So you have a push down, you're starting to slow down the momentum. You have indecision candle, this doji formation here, or this doji candle. A doji candle is one that has a little body but massive wicks. All right, so really just more wick than body. It indicates that the bears and the bulls are basically fighting for which direction it wants to go, and they're evenly weighted, meaning that it doesn't want to go short, doesn't want to go long, so it's kind of indecisive. Now, when you see these candlesticks, you can say, okay, well, the volume and the momentum has shifted, or starting to shift, or could potentially be shifting, starting to slow down. All right, then when you see 1 pin, 2 pin, and that 3 pin engulfing back to the upside, the bulls have regained control, and we could be in for either a pullback or reversals back to the upside. In this case, we did make a further leg, and it's also seen over here as well. All right, 3-pin pattern: 1 pin, 2 pin, 3 pin. This kind of is a doji. I would like to see more wick on this one to the upside, but it is a slowdown in momentum. All right, we were pulling back here for a potential another leg to the upside here. All right, so 1 pin, 2 pin, 3 pin, engulfing candle to the upside. It's also seen on Euro USD, and they're seen everywhere, but I'm just going to show you a few examples here. Euro USD on the 4-hour time frame. All right, right in here. 1 pin, 2 pin, 3 pin, engulfing. All right, so indecision, meaning the bulls came in, the bears came in, and they couldn't find which direction they wanted to go, and they kind of closed where it opened. All right, as in when this candle opened, it closed relative to where it opened as well. And then we had that 1, 2, 3 wick, 1 wick to the upside, 2 wicks to the upside, 3 wicks to the upside, engulfing back to the downside, signifying that the bears are starting to come back into the market and regain control. Okay, so I'm not telling you that when you see 3-pin patterns, you need to be selling. In this instance, when you see them to the upside, you need to be buying. You have to use them in conjunction with one another and your other confluences for your particular strategy and your particular pair that you trade. Okay, but they can be used to potentially signify some sort of bias or shift in momentum, shift in structure that could be used for in confluence with the particular bias that you have. All right, so the next one I want to go over is on the dollar index, right here on the daily time frame. Easily identifiable, right here. 3 pins, 1 pin, 2 pin, 3 pin, shift. And it also reacted off of a significant level, and this one we'll go over more in depth on, smart money type of entries and concepts in the advanced course. But it reacted off of some sort of level, and it created the 3-pin pattern. So it just gave me that extra confirmation that we could potentially be going really long on this pair, or on the dollar index for this matter. All right, another one right in here. 1 pin, 2 pin, 3 pin, price pushed up, slowed down, indecisive candle. All right, engulfing back to the downside, shift in momentum, shift in structure. Okay, so I'm not telling you just to be selling it right here. Okay, I'm telling you that if there is a potential shorting opportunity that aligns with your rules and you have other confluences that's surrounding it, and you also have this 3-pin pattern here and the engulfing, that's a good sign that we could potentially shift and go to the downside now. In this case, we did. All right, so the next pattern that I would like to go over And again, this wasn't a pattern, this was a formation. But a pattern that I want to discuss with you today that I really like to trade, it's a retail pattern, but it's really the only pattern that actually makes sense institutionally, is an inverse head and shoulders and a regular head and shoulders. All right, and this is easily identifiable on the 30-minute time frame on USDJPY. All right, scroll over, and it is right over here. All right, so an inverse head and shoulders is usually seen at the bottom of a downtrend or at the bottom of a pullback. All right, and a regular head and shoulders is usually seen at the top of an uptrend or at the top of some sort of pullback, all right, depending on which direction you're trading. All right, so an inverse head and shoulders for this instance, we can see that we have left shoulder, head, right shoulder. All right, we come back up to the shoulder line here. All right, you have to come back up to the shoulder line with this. All right, so you have that left shoulder, head, so it dips a little bit lower than this swing point here. We come all the way back up, almost having 100% retracement back up to the shoulder line. We dip back below, again, not breaking this level. All right, and we come back up, and then we break this, I guess, quote-unquote resistance level. All right, so getting rid of this, you can see that how can we potentially trade this? Well, if we notice, because we have to use this in conjunction with the higher time frame, or really your overall move, is we can see that we had a push, one push, a pullback, two push, and then this happened to be at the bottom of the pullback. Okay, so inverse head and shoulders to continue up, bottom of the pullback. So one drive, two drive, three drive into the high. Okay, good sign that we're going to start shifting and going back to the upside now. All right, so this is going to be the end of the pullback. So where could you potentially be trading this? Well, you have to draw your zone. So your zone of interest is going to be at the neckline, which rests right in here. Okay, I say this because this is where price stopped. We broke it and we re-broke that back to the upside. Came back up to the shoulder line here. All right, dipped back down and touched that exact same point. And this is where you want to be pulling your fib. So from the low to the high, we came into the 61.8, lined up with this, with the neckline here. All right, and then we made a move to the upside. You can see the symmetry in this, okay? So this move right here is basically the same as this move here, all right? The only difference is that we dip down a little bit lower in between, all right, potentially taking orders, shifting back to the upside, creating equal highs, coming back down, testing that demand level again at that same point, and then continuing to the upside. All right, so that is an inverse head and shoulders. Subsequently, a head and shoulders is very similar, guys. It's really just the opposite, okay? Top of an uptrend, top of potential pullback. So we have left shoulder, head, right shoulder. All right, you can see head and shoulders. It just makes sense. This is where you'd like to be entering, right in here. All right, because this happened, then it comes back up to the same level. You want to be entering right in here. You can pull your fib from the high to the low. In this case, we came to in between the 61-71% fib retracement. All right, and we can take a short opportunity. Now, where would be your targets on this? Well, you could identify a potential target on the higher time frame, or the rule of thumb for me is if you are looking at an inverse head and shoulders or regular head and shoulders, you can duplicate the range, all right, from the head to the shoulder line. So duplicate it. Oops. Pull that back up there, just about right there. And that could be your first target, all right, right in here. All right, that could be your first target, which was met very swiftly before pulling back. So that was a good target. If you had entered here, it would have taken you maximum of 1 day, 9 hours, which in this case, 130, 140 pips on USDJPY is absolutely incredible. So I hope you can grasp the concept of the inverse head and shoulders and the head and shoulders pattern. And it is a retail pattern, but it does signify a shift in momentum. It does signify a shift in structure. Now, going back to what I said about candlestick formations, all right, hopping to the 30-minute time frame. So before we get into that, we identified that we came into this level of interest, right? And we had an entry here, all right? Inverse head and shoulders, the right shoulder here, all right? Entry there. Now, scaling in. Now, let's say you didn't want to enter there, right? So say for some reason maybe you missed it or you weren't quite convinced. Well, here's another thing you can see, all right? Well, another one is a potential 3-pin pattern on this to go long, all right? So what we had here is we pushed up. There was no 3-pin pattern here, so if you didn't get in, all right, fine, but we broke counter trend structure. So lower low, lower high, lower low, lower high, lower low, higher high. You broke this previous high that made the low. So you're now shifting counter trend structure, and now you know that we're not going to come below this level, and now we're going to go long. Okay, so now where can you potentially get it? Now, if you want to trade, if you confirm it and you want to trade off of maybe a 3-pin pattern or some type of formation or candlestick formation, well, then maybe you can just wait for price action to maybe, come down when we pull back, start to slow down and create that 3-pin. In this case, you would have found it right in here, just about, or right in here. All right, you had a pin to the downside, pin to the downside, pin to the downside, engulfing candle, stops below this low here. All right, so you wouldn't have entered here, would have gotten a better risk to reward anyways. So in this case, we dipped down a little bit more and then we rallied to the upside. Now, if you had kind of identified this as well, a lot of, push down, then we just indecisive, 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 doji, 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 engulfing candle to the upside, enter here, stops below the low, and then we regain the bulls back into the market, and then we continue up. All right, so that is what you can use in conjunction, and this is what I mean, guys. If you identify 3-pin patterns in an area of interest, then it could just help you further your bias to continue in that direction that you have always identified. All right, so the next formation that I want to go over with you guys is on the 4-hour on USD CHF. If I can just find it. There it is. All right, and it's called a pennant formation. A pennant formation, let me just draw it up and you'll easily understand what I'm talking about. Does that not look like a pennant to you guys? I mean, we have, I guess, your pole. You have kind of like a flagpole almost, a push to the upside, and you have a pennant. It's just like what you see on top of a car for maybe a sports game or something like that. All right, now a pennant is interesting because it's actually different than a flag, and I'll get into a flag in a minute. But a pennant doesn't really signify that liquidity has been taken on either side. So what you have here is you're just condensing yourself horizontally. All right. In this case, you come up, you didn't take this liquidity. You come down, you didn't take this liquidity. You come up, you didn't really take that liquidity. Came back down, never really took this liquidity either, and you're just kind of trapping yourself, you're squeezing yourself, not taking liquidity to the upside or the downside, because you can see that we're pushing down here, pushing up here, so no liquidity has been taken. All right, so in this case, what you could do is if you're going to trade the break out of this, as in a break, in this case we broke to the downside, a break, retest, and we fell. All right, what you could do is just wait for the break on either side because it really can go either way for a pennant. So it can break to the upside, pull back and go long, or break to the downside, pull back and go short. In this case, we pulled back here, we broke to the downside and went short, all right, taking all this liquidity. Now we want to take all the liquidity, which we did, all right? So let's say I broke to the upside, right? Broke to the upside here, broke, pulled back, then you can take this long off of a retracement, maybe pull a fib and find some other confluence as well, maybe a 3-pin pattern down here, and then look to go long, okay? So where would your targets be? Well, in this case, your targets for this, since we broke to the downside, what you would like to see, it's a continuation of the downside, and what I say earlier about inverse head and shoulders, you'd like to take the distance between the pole, actually you take the pole distance, and then you put it to the downside. Well, in this case, there are other confluences that suggest we might be going long here on USD Chef, and this is more likely seen if you're trending to the upside. So normally you don't like to see a break to the downside just because you have the massive push and then you kind of consolidate it into this pennant formation. Like you like to see another push to the upside again to continue with the trend. In this case, we broke to the downside, so there's really nothing we could do. You can trade this. You can take, pull a fib from this high to this low here maybe. Let me just get rid of this. Actually, let's move it out of the way. Maybe pull a fib from the previous high that it made to the low, pull back 61.8, we can fall to the downside and maybe target a fib level extension or something like that. I don't like to see it break to the downside when we have a bullish pennant because I always like to see it push back to the upside because we had that initial push to the upside here, consolidated, and then we want to see another push. So in this case, we didn't get it, but if we did get it, I would have targeted the duplication of this pole, okay? And your target would be right about here. You would put it, the base of it would be where we last came into before rising, okay? So in this case, if we entered a trade, we would target 1.0374. All right, so that is a pennant formation. Now a flag formation is a little bit different. Okay, a flag formation is one that we have a clear direction, as in a clear pullback. This isn't really a pullback, it's more of a consolidated period. All right, a flag formation is very similar. We have our pull, but in this case, a bullish, this is a bullish flag. We start to pull back when we trend down, okay? So you can see that we have this flag, all right? So it's taking liquidity. Every time we make a new move to the downside, we're taking previous liquidity, okay? So we push down, took that liquidity. push down again, took that liquidity, push down again, took that liquidity. But we have all this liquidity right here that has not been taken. All right, so this is why flags break to the upside. So what you would do is take the same distance from here to here from the pole, duplicate it, and wherever it stopped before breaking, that's where you would target. Okay, you draw it there, and your target would be, in this case, if we entered here, your target would be 1.0911. Okay, duplication. All right, it breaks to the upside on a normal basis because liquidity has been taken here, but not up here. That's why it breaks out. And the momentum here, push to the upside, pull back, push to the upside. Okay, in this case, we weren't really pulling back, so liquidity wasn't taken to the downside nor the upside. So it's really, you can't really tell where it's going to go. Sometimes it breaks to the downside, sometimes it breaks to the upside. But in a flag, you have a better bias in determining where it's going to go next. And that's why I said earlier when we first started this video is that candlestick formations and patterns can help determine potential bias for the next larger move. In this case, we could potentially see, okay, we have a flag. All right, our bias could be long for the next larger move, and we have our target here with the duplication. All right, so that is a flag. Now, the next pattern I'm going to go over with you guys is called a rising wedge or a falling wedge. And actually, I'll just do a bear flag really quick. This is a bear flag. So we first had the bull flag, which was this. All right, so you have the flag, and we push to the upside. All right, a bear flag is the same, but just the inverse. All right, push down, pull back up this way, forming that bear flag, and then push to the downside. All right, duplication of this. All right, but now a rising wedge and a falling wedge is something a little bit different. All right, so a rising wedge is a push to the upside, and then you're not pulling back, but you're rising up in here. You're pulling back as in you're chopping up. All right, so what you're doing in this case, so you're squeezing yourself. Okay, so you're squeezing yourself into a tighter range here. Okay, but instead of pulling back, because normally on a flag you like to pull back down this way and then go up again, right? In this case, you had your initial push, but then you're continuing to rise with smaller pullbacks, and you're squeezing yourself. It's called a rising wedge. Just like I said, a wedge. I mean, you're wedging yourself into a tinier and tinier area of price. So what happens here is that liquidity has not been taken to the downside because it's making higher highs and higher lows, but it has been taken to the upside in every single push. So what you like to see is a break to the downside. Once it squeezes itself so much, it needs to break out, and usually you like to see a break to the downside to take all that liquidity. And I guess you could, for your targets, you can take the duplication of the initial push and target where you first broke out, and then duplicate that and put it here. All right, and that will be your target right in there. Okay, so that is a rising wedge. A falling wedge is just the same thing, but a push to the downside first, and you're trapping yourself into a smaller and smaller pocket in here. All right. Okay, so it's like that, and you like to see a break. You like to see a breakout, and a liquidity here has not been taken. All right, but here it has. So where would you like to go? You'd like to see a breakout to the upside, right? In this case, push up, wedge up, break to the downside. Push down, wedge down, break to the upside. Again, duplication from this initial push, duplicate it here. That would be your target. Okay, so you have to think about it in terms of liquidity. Where is the liquidity? Well, you're squeezing yourself, so you need to see a large breakout, but where has the liquidity been taken? Well, in this case, all the liquidity is still up here because we're making lower lows and lower highs in this squeezing wedge. Well, we have been taking all the liquidity in here. All right, we haven't been in here, but we have been in here. Again, we haven't been down here, but we have been up here. So we break to the downside to take this liquidity, break to the upside to take this liquidity. So I hope that makes sense. And again, you always want to be trading these types of formations and patterns in conjunction with other confluences for your particular strategy, for your particular trade or your setup. Okay, but you can use this. You can see these formations and be like, okay, well, I think that seeing this formation, this is a rising wedge. We may be breaking to the downside soon. So if we break, we see a break of the downside and then pull back, and then we can duplicate the movement and then target that, and then just keep going. Just push to the downside, maybe pull a fib. So something like this. Let's get out of this. So if we break, maybe break to the downside here, pull back, maybe pull a fib from the high to where it broke out, maybe 61.8, something like that, in that golden pocket, and then a fall, and then duplication. So that's how you would like to look at these type of candlestick formations and patterns, right? So now, the next one I want to go over with you guys is a bullish engulfing candle. Bullish engulfing candles and bearish engulfing candles. I'm going to show you this on the dollar index again on the daily time frame. All right. So a bullish engulfing candle doesn't mean that we're going to shift to the upside. Okay. It just means that the volume has shifted and we could potentially be seeing a larger pullback or a potential reversal. And this can be seen on any pair, on any time frame. You just got to look for the engulfings. So for instance, right here, we push to the downside and the bullish engulfing engulfs the whole candle, the whole previous candle that it formed. Okay, so this push down, it opened here, it closed here, opened here, and we close all the way back up here. We engulfed this previous candle. So in this instance, in conjunction with other confluences, this actually went long, and we took this long. All right. But you can see here that, well, we pushed down, we engulfed here, we only pushed up a little bit and then we continue to fall. Why is that? I thought bullish engulfing candles means shift. Well, again, you have to use it in conjunction with other confluences. In this case, we're pulling back here, all right? We're pulling back. We're making lower lows and lower highs on a pullback. So why would we expect this to go long just because we saw a bullish engulfing candle? Now, if you see a potential formation in here, as in a potential setup to go long, maybe to reach some sort of pullback, all right? Maybe pull back into this level here, but you see a potential entry here. If you see this bullish engulfing candle, then you can potentially take along into some pullback area in here. All right, same goes for a bearish engulfing candle, right? So we are making lower lows and lower highs, right? Lower low, lower high, lower low, lower high. Oops, excuse me, lower low again, lower high. And since we're making lower lows and lower highs, we came up to our LPOR, meaning our last point of return. This is the last swing point. All right, that made the new low, so we should expect price not to break this level and continue lower. All right, which we did. We came up to the LPOR, we pushed up, and we engulfed back to the downside. In this case, you're trading in the direction of trend, and you're engulfing to the downside on your swing point. So that's a good indication that we're going to start shifting structure again to the downside. So we're ending this pullback here, and now forming that new leg to the downside. Okay, so it's just used in conjunction with other confluences that can potentially help you identify where the volume has been shifting to and where it could potentially go next. All right. A bearish engulfing candle is another example on GBP CAD on the daily time frame. And in this case, we're right in here. All right. So this is actually considered a railroad as well. All right. So a bearish engulfing candle, we pushed up. In this case, we took liquidity here. And this, again, we'll all be talking about liquidity and liquidity runs and purges in the advanced course. But for instance, we pushed up, we pushed back down, we engulfed back to the downside. All right, we engulfed this huge candle that we made. So push up and push back down, engulfing, and we continue to the downside. All right, momentum has been shifted back to the bears, and we continue downside here. This is also the same thing as a railroad. So a railroad is one that obviously would open and close at the same point. So we opened, or we closed here, and we opened here. So that's just how candles work. But then it closed back where it initially opened. All right, so it's like a parallel line. You can kind of see the same distance. All right, so obviously when you close here, you obviously have to open here. That's just a given. But when you close where you opened, that is considered a railroad. So it's an engulfing candle, a railroad, and that's indicating a shift in the volume and then a shift in momentum to continue to the downside. In this case, since we engulfed to the downside here. All right, so that is what a railroad and a bearish engulfing. Just a couple examples of that. So really, that's all I have in terms of candlestick formations and patterns. You remember to use them in conjunction with other technicals, other for your particular strategy, other confluences. So don't trade just solely these patterns and formations. They will haunt you the rest of your life. If you use them in conjunction with everything else that you have been taught or your particular strategy, you can be very successful. Okay, because just recognizing them, training your eye, and seeing them can drastically help your profitability in the market. Okay, because it helps you identify where price can potentially go next in terms of formations, and then candlestick patterns, potential shifts in the structure, potential shifts in volume, potential shifts in momentum. Okay, so I hope you learned a lot. If you have any questions about anything else, about any patterns or other formations that maybe I didn't go over that you are excited to learn about, because there are more out there, but these are the most prevalent ones in the market. But if you have any questions about these or anything else, please feel free to contact us and let us know, and we'll get back to you. So hope you learned a lot. Thank you very much for your time, and let's get ready for the next video. Thanks, guys.